Assalamualaikum warahmatullahi wabarakatuh. Me, Adil Iman Putra bin Mat Bahrudin with three others group members, which is AKMAL, ABDUL, and Ahmad HILMI, will present about fundamental of financial reporting assignment. So, for the first one, which is MFRS 116, property, plant and equipment are tangible asset retained for use in the production or delivery of goods or services for rental to others or for any administrative purposes and intended to be used over a period. However, PPE categorized as held for sale, investment properties accounted for using for fair value, biological asset relating to agriculture activities, and exploration and evaluation asset are not covered by MFRS 116. The standard goal is to establish an accounting standard for property, plant and equipment as well as changes in shares investment. The recognition of asset, the assessment of their carrying amount, and the depreciation changes and impairment losses to be reported in relation to them are the main concern in PPE accounting policies. As overview, we can see that recognition and initial measurement of asset are when it is likely that future economic benefits connected with the asset will flow to the company, and item in property, plant and equipment should be recognized as asset if the asset cost can be precisely determined. Then, a cost should be documented for a piece of property, plant and equipment. The purposes of revaluation is to ensure that the carrying amount does not differ considerably from that calculated using fair value at the date of the financial statement. Next, measurement subsequent to initial measurement and recognition are two accounting models are allowed: cost model and revaluation techniques. The asset is carried at cost less cumulative depreciation and impairment under cost model, while the revaluation technique is defined as carried at a revalued amount, which is its fair value at the date of revaluation less subsequent depreciation and impairment, provided fair value can be reliable measure. The second is MFRS 140. This MFRS 140 distinguishes between investment and owner-occupied properties. Property, plant and equipment is defined as property held by the owner or by the lease under a financing lease for use in the production or delivery of product or services, or for any administrative reason. Under MFRS 116, investment property do not include owner-occupied properties or those kept for sale in the ordinary course of business. There are a few examples of investment properties such as land held for long-term capital appreciation rather than for short-term sale in the ordinary course of business. Land held for undetermined future use, such as a building owned or held under finance lease and leased out under operating lease. Other than that, a building that is vacant but held to be leased out under operating lease, and property being constructed or developed for future use as investment property. Investment property should be recognized as an asset only when it is probable that future economic benefit associated with the investment property will flow to the entity, and the cost of the investment property can be measured reliably. Other than that, daily maintenance costs are not taken into account, and if the expenditure fits the recognition criteria, further costs for the replacement of section of the property are recognized. The carrying amount of the substitute part is ignored. All investment properties are originally valued at their current market value. The initial measurement should include transaction expenses. A purchased investment properties cost include the purchase price as well as any directly relevant expenditure such as legal fees, property transfer taxes, and other transaction charges. There are no startup costs, operating losses, excessive amount of lost material, or labor expenditure involved. The cost of an investment property is the cash price equivalent if payment is deferred. Over the credit period, the difference between this amount and the total payment is recognized as interest expenses. Now we go to the next presenter.
Okay, my name is Ffr Presentation. So now we will go to example of MFRS 116 property, plant and equipment, and MFRS 140 investment property. So now we will go through with example of property, plant and equipment of Kandar Group and Berhad 2021. So we will go to the first one, measurement. The cost of replacing a portion of an item of property, plant and equipment is included in the carrying amount of the item that is expected that the future economic benefit reflected in the portion will accrue to the group, and if the cost of the replacement can be reliably estimated. The expenditure associated with the routine maintenance of property, plant and equipment are included in the profit and loss as incurred. For recognition, the fair value of property, plant and equipment on the date of acquisition is used to calculate the amount of the cost that is recognized as a result of a business combination. the estimate amount for which a property could be exchanged on the date of valuation between a willing buyer and a willing seller in arm's length transaction following proper marketing, wherein the parties had each act knowledgeably, prudently, and without being compelled, is the fair value of the property. This amount is referred to as the market value of the property. The market price that are provided for goods that are comparable to other price or piece of a plant and equipment are used to determine the fair worth of those other pieces. Due to the acknowledgement, the recognition of property, plant and equipment take place either when the item is sold or when it is judged that there will be no more economic advantage gained from the use or sale of the item. Lastly, we will go to the disclosure. The residual values, useful life and depreciation method are received of each reporting period, and to ensure that amount, method and period of depreciation are consistent with previous estimates and the expected pattern of consumption of the future economics benefit embodied in the property, plant and machinery. So now we will go to the MFRS 140 investment property of Kamda Group and Berhad 2021. So the first one, we will go to the disclosure. Investment properties are property owned or held under a leasehold interest for the purpose of earning rental income, capital appreciation, or both, but not for sale in the regular course of business, used in the manufacture or supply of commodities or administration. In the measurement of investment property in Kamda Group and Berhad 2021, initial valuation of investment properties included transaction charge. Consequently, investment property are measured at fair value, which reflect market circumstances at the date of reporting. Gains and losses resulting from changes in the fair value of investment property are recorded in the period in which they are occurred, when the fair value of an investment property under construction cannot be reliably determined. The property is measured at cost until either its fair value becomes reliably determinable or construction is complete, whichever occurs first. Cost includes expenditure that is directly attributable to the acquisition of the investment property. The cost of self-constructed investment property included the cost of materials and direct labor, any other cost directly attributable to bringing the investment property to a working condition for their intended use, and capitalized borrowing costs. Lastly, we will go through with the recognition of investment property in Kamda Group and Berhad 2021. Investment property are derecognized when they are either disposed of or permanently removed from use, with no anticipated future economic gain from the disposal. Any gain or loss to the retirement of sale of an investment property is shown in the profit or loss for the period in which the retirement or sale occurred. Transfer to investment property only occur when the property's use changes. For a change in use from investment property to owner-occupied property, the presumed cost for subsequent accounting purpose is the property's fair market value on the date of the shift. If an owner-occupied property is converted into an investment property, so we will go to the next company that will explain by Ahmad Ilmi.
Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Ahmad Hilmi. So let's go through for example of plant, property and equipment for Malaysia Pacific Corporation Berhad, or as known as MCOP. So there are two examples for their PPE, which is measurement and also recognition. Let's go to the measurement first. Cost includes expenditures that are directly attributable to the acquisition of the asset and any other cost directly attributable to the bringing the assets into working condition for its intended use, as well as of replacing components, part of the assets, and present value of the expected cost for decommissioning the asset after their use. In addition to the cost of materials and direct labor, the cost of self-constructed assets also includes the cost of raw resource. Borrowing costs are capitalized for qualified assets in accordance with the accounting policy borrowing costs. All other repairs and maintenance expenses are accounted for in the profit or loss when they are incurred. So let's move to the recognitions. The cost of property, plant and equipment recognized as a subsequence of a business combination is determined by the fair value at the date of the purchase. The fair value of property is the two estimated amount for which a property might be traded on the date of valuation between a willing buyer and also willing seller in arm's length transaction following the accredited marketing, in which party acts with the knowledge, caution without the caution. The fair value of the other plant and equipment is based on the market price for the comparable products. When a main component of a piece of property, plant and equipment have a varied useful lifetimes, they are recorded as the independent items, which is major component of the property, plant and equipment. Property, plant and equipment are depreciated upon disposal when there are no anticipated future economic advantage from their use or disposal. Gain or losses resulting from the sale of property, plant and equipment are calculated as the difference between the proceeds of the sale and the carrying amount of the assets, and are recognized in the profit or loss. I think that's all from me. Thank you. I will pass to the next presenter.
Assalamualaikum, my name is ABDUL. So I will explain about MFRS versus MPERS. Look at the first MFRS versus MPERS, which is plant, property and equipment of recognition. For MFRS, demands that the company recognize it as part of their other comprehensive income as well as accumulate in their equity. In addition to this, it necessitates those entities match the revaluation, rise or reduction on an item by item basis. And for MPERS, entities are required to compute for revaluation increases or decreases that relate to revaluation surplus in net assets or equity, with a constraint placed on revaluation decreases. It gives entities the ability to compensate for increases and decreases in revaluation for particular assets by offsetting such changes against one another within the same class. The second MFRS versus MPERS property plant equipment of depreciation is, for MFRS, requires that the residual value, the useful life, and the method of depreciation of an asset be reviewed at least once at the end of each fiscal year by the entities that own the asset. This review must take place in their last month of their financial year. It is not suitable to compute depreciation based on revenue earned by an activity that includes the use of an asset, since this is not how depreciation should be determined. For MPERS, demands that entities examine them only when there are indications that there has been major alteration in the environment. A technique of depreciation that is appropriate takes into account the income that is produced by the activity that includes the utilization of an asset. The last one for MFRS versus MPERS of property, plant and equipment for initial measurement. For MFRS, when an asset is first recognized, it is required that its cost be utilized as the foundation for measuring that asset of part of the accounting process. In MFRS 116 of the standard, there is no requirement for a non-exchange transaction to be performed. A non-exchange transaction is not commonly employed in the private sector, since it is not appropriate to the context of the industry. This is due to the fact that companies that operate in the private sector maintain their business activities separate that from one another. For MPERS, remains that companies first determine the value of their property, plant and equipment depending on the amount of money they have. In addition to this, the MPERS system requires the measurement of transactions that do not include the trading of commodities or services. It is also standard practice for organizations operating in the public sector to acquire an asset through a transaction that does not include the exchange of commodities or services. This kind of acquisition is known as a gift in the given circumstance. So we look for investment property for MFRS versus MPERS for disposal. For MFRS, when an investment property is sold or when it is permanently removed from use and normal economic benefits are anticipated from its sales, the property is said to have been recognized as an investment property. For MPERS, there is no MPERS for disposal. Look at the point number 2, which is transfer for investment property for MFRS versus MPERS. For MFRS, transfer to investment status upon the occurrence of a change such as the start of development with the intention of selling the property, the beginning of owner occupation, the conclusion of owner occupation, or the beginning of an operating lease with another party. For MPERS, change the classification of the property from investment property to property, plant and equipment. It is not longer possible to get an accurate estimate of the property's fair worth without incurring excessive costs or efforts. Aside from that, a transfer is considered to have taken place when the investment property initially met or ceased to fulfill the criteria of the investment property. The last one is investment property for MFRS versus MPERS for a first adoption. So look at the MFRS. A first-time adopter may elect to measure the investment property at their fair value when reliable cost information about the asset and liabilities is not available and use the fair value as the deemed cost. For MPERS, when accurate cost information regarding the asset and liabilities is not available, a first-time adopter has the option of measuring the investment property at its fair value and using that value as the considered cost instead of the actual cost of the asset or liability. So that's all from me. So let's continue to the next presenter.
So, as a conclusion of MFRS 116, generally the property, plant and equipment assets are report their cost followed by a deduction for accumulated depreciations that's applied to all these assets. Property, plant and equipment is initially measured according to its historical cost. Property, plant and equipment, it has a long useful life. Fixed assets are expected to yield service over several accounting periods. For MFRS 140, investment property is prescribes the accounting treatment for investment property and the related disclosure requirement. The property held by the owner and the held by the leases under a finance leases may be classified as investment property. However, a property interest that is held by a leases under an operating leases may also be classified and accounted for as investment property. I think that's all from me and our group. Thank you for watching.